Welcome to The Explainer. Today, we're doing something really exciting. We are extracting the foundational principles of wealth creation straight from Warren Buffett's historic shareholder letters. These aren't just your standard, dry corporate memos. We're talking about decades of unfiltered wisdom, strategic masterstrokes, and candid reflections from literally the greatest investor of our time. So we're going to skip right past the dense financial jargon and zero in purely on the timeless, foundational strategies that turned a struggling, obscure little company into an absolute global house power. Let's dive right in. To really wrap our heads around this transformation, we've got to travel all the way back to 1965. Picture this, all right? A single share of Berkshire Hathaway was trading for around just $18. This was an era way before modern algorithms, before high-frequency trading, and definitely before the 24-hour financial news cycle we have today. Back then, an $18 investment was just a stake in a mundane, struggling business. But as you dig into those early letters, they chronicle the quiet, methodical genesis of an empire. They literally give us a front-row seat to the evolution of a financial philosophy that would completely change the investing world forever. And from those incredibly humble beginnings, we arrive at this staggering number, 7,448. That right there is the multiple of growth for Berkshire Hathaway, documented over the course of 48 letters. It's absolute, undeniable mathematical proof of Buffett's true superpower. And look, that superpower isn't predicting the stock market, and it's definitely not timing the economy. It is capital allocation. Put simply, capital allocation is just the skill of taking cash generated from one business and expertly deciding exactly where to place it next to get the absolute maximum long-term return. It's like he was wired at birth to deploy capital like a grandmaster moving chess pieces. So here is our syllabus for today's masterclass. We'll be breaking down Buffett's specific financial disciplines into 5 clear sections. First, from textiles to billions. Second, the magic of float. Third, the double-edged bank sword. Fourth, cheering for falling prices, and finally, the mindset of value.
All right, Section 1, from textiles to billions, the great pivot.
Believe it or not, the original Berkshire Hathaway was actually a textile mill, and it perfectly represented what Buffett used to call a cigar butt investment. Imagine finding a discarded cigar on the street. Gross, I know, but stick with me. It might have one free puff left in it, but fundamentally, it's a dying asset. In the 60s and 70s, the textile industry was just this constant, exhausting drain on capital. The company was facing fierce foreign and domestic competition, and they were locked in this agonizing struggle with totally obsolete machinery. Every single time they generated a little bit of cash, it had to be poured right back into expensive factory upgrades just to tread water. The returns were essentially zero. But then came the brilliant aha moment. The pivot that changed history was stepping away from the looms and acquiring insurance and banking businesses. Instead of these capital-draining machines, he found lucrative, cash-generating engines that offered vastly superior returns entirely without the constant need for heavy capital expenditures. A total game-changer. Which brings us to Section 2, the magic of float. Measuring insurance. Now, most traditional businesses make money by simply earning more than they spend, right? You sell a product, you keep the margin. Simple. But insurance? Insurance is a completely different beast, and it revolves entirely around this concept called float. Think of float as other people's money. When customers pay their insurance premiums, the insurer collects all that cash up front. But they haven't actually paid out any claims yet. So that massive pool of cash doesn't actually belong to the insurer, but they get to hold on to it. And while they hold it, they can invest it to generate significant income long before it's actually needed to pay a claim. It's basically a massive, compounding engine powered entirely by free capital. Well, I say free, but float isn't automatically free. Its true cost is measured by a crucial metric called the combined ratio. This is simply the cost of claims plus operating expenses divided by the premiums collected. If this ratio is exactly 100%, the insurer is just breaking even from its core operations. Anything over 100%, that means the insurance operations are actually losing money just to hold on to that float. But here is the absolute holy grail of insurance, operating under 100%. When an insurer achieves an underwriting profit, they are effectively being paid by their customers to hold and invest that massive pool of other people's money. That exact magic is what Buffett harnessed to build his empire. Now, the type of insurance you underwrite totally dictates your timeline. Short-tail insurance, things like crop insurance or auto collision, sees claims come in incredibly fast. A storm hits, the crops fail, and you have to pay out immediately. This leaves very little time to actually invest the float. But long-tail insurance? Think medical malpractice or asbestos liability. That is where the real compounding advantage lies. Claims in these categories can take years, sometimes literally decades, to arrive, and even longer to fully settle in court. That provides an insurer with a massive, multi-year runway to invest that float, allowing the returns to compound exponentially over time. But to make this work, you need ruthless discipline. You absolutely have to manage that float wisely. The ultimate goal here is to break even on the underwriting and let that investment income serve as a pure bonus. The danger, and honestly, this is where a lot of insurers completely fail, is chasing premium volume. You simply cannot afford to aggressively underprice long-tail risks just to get your hands on more float. If you do, it's going to turn into a catastrophic money pit years down the line when those underpriced claims finally mature. It's entirely about quality underwriting over volume. You've got to carefully track the true cost of your float over time. And if you manage it right, it becomes a serious, unstoppable value creator. Let's move to Section 3, the double-edged bank sword, risks and leverage. So banks operate with immense leverage. We're talking often up to 20 times leverage, meaning for every single dollar of their own money, they might borrow $20 to lend out. Because the stakes are so astronomically high, bank executives often fall into this incredibly dangerous psychological trap that Buffett calls the institutional imperative. This is basically the tendency of banks, usually driven by ego and intense peer pressure, to blindly copy the behavior of their rivals. Like if the bank across the street is making aggressive, highly speculative commercial real estate loans because the economy is booming, the institutional imperative dictates that you do it too, regardless of whether it actually makes any economic sense. It's literally a copycat game played with billions of dollars. Because of this, Buffett strongly favored banks that actually prepared for disaster. Let's walk through this conservative 1990 Wells Fargo stress test detailed in the letters. It really proves how a well-managed bank builds a true margin of safety so they can survive severe economic shocks. Look at this. Even if a staggering 10% of their massive $48 billion loan book went completely sour and they lost 30% of the principal on every single one of those bad loans, the bank still wouldn't collapse. In fact, because of their strong pre-tax profits, they would essentially just break even. Buffett loved this because it mathematically demonstrated that a true margin of safety protects you from total ruin, even when the economy falls completely off a cliff. Because of that intense leverage we talked about, the ultimate lesson here is to never ever buy a bank just because its stock is cheap. Strong conservative management is literally your only defense against the crushing weight of bad loans. As Buffett famously warned, it's only when the tide goes out that you discover who has been swimming naked. And in the banking sector, high leverage means the tide can go out very, very fast. When a crisis hits, a cheap stock price is not going to save you. Only exceptional management quality will. Moving on to Section 4, cheering for falling prices, market psychology. I want you to ask yourself something. Why do we absolutely love a sale at the grocery store, but we completely panic when stocks go on sale? Seriously, why do we prefer paying less for clothes, electronics, and fuel, but we completely abandon that exact same common sense logic the second we open our brokerage accounts? When the stock market falls, the public panics. When it rises, they cheer. Why on earth do we let the blinking red lights on a stock ticker override our basic consumer rationality? If you're going to be buying assets for the rest of your life, cheering for higher prices makes absolutely zero sense. There's this incredibly powerful quote from Bertrand Russell. Most men would rather die than think. Many do. This serves as a really stark warning about blind contrarianism. You absolutely need independent thinking, not just an anti-herd mentality. Just because an asset is hated by Wall Street and the price is plummeting, that doesn't automatically make it a fantastic buy. Sometimes a stock is cheap because the underlying business is truly broken. You can't just blindly buy the dip. You have to actively think critically and verify that the underlying value is actually still intact. If you consider yourself a net buyer of businesses over your lifetime, you should actively welcome market pessimism. Falling prices are a lifelong investor's greatest ally, purely because they lead to significantly better purchase prices. Conversely, high prices make it incredibly hard to invest your capital effectively and actually generate strong returns. You want to buy when pessimism is incredibly thick in the air. Now, doing this requires immense emotional fortitude. You need the ability to stand firm in a volatile market that's offering up mispriced opportunities and rely entirely on your own independent evaluation of a business's true worth, completely ignoring the noise. And finally, Section 5, the mindset of value. Concluding thoughts. You know, Wall Street is absolutely filled with people who possess incredibly high IQs, yet they routinely lose absolute fortunes because they lack the emotional temperament to stay rational during a panic.
Buffett's letters ultimately teach us a profound and really comforting truth. Good investing is far less about raw intelligence and far more about mindset, emotional discipline, extreme patience, and the ability to think clearly when everyone else is reacting blindly. That is what will beat a complex spreadsheet every single time.
Price is what you pay, value is what you get. This iconic quote anchors everything we've explored today. I want you to think about it as the massive crescendo of his entire philosophy. From mastering the nuances of insurance float, to avoiding the catastrophic dangers of bank leverage, to actively exploiting market panic, every single strategy serves this one singular, overarching goal. You are always, always looking to acquire more intrinsic value than the literal price you're paying out of pocket. It is simply about trading 50 cents for a dollar's worth of value over and over again.
So I'll leave you with this. When the next market panic inevitably hits, and believe me, it will you run with the terrified crowd, or will you step back, think independently, and start aggressively searching for value? I want you to challenge your own investing psychology with that thought. Thank you so much for joining me for this explainer. I really hope diving into these historical letters gives you a much sharper, calmer lens for your own financial journey. See you next time.